Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, March 10th, 2022. This is actually my second stab at doing a video today. I started one earlier, and there's so much I want to cover that I found myself 30 minutes into that and still covering just simply bonds or really interest rates. I didn't even get to the individual charts of the bonds I wanted to cover, and I was talking about that and really the Fed. How it relates to interest rates and then the stock market economy, it all ties in together. But anyways, that one was going so long I didn't even get to the individual bond charts yet. So I decided to just pull the plug, and I'm going to break these down to keep them manageable for you guys. This is part one, stocks. We're just going to look at the equity markets and maybe a couple trading considerations, because that's what I wanted to get in there as well. And then I'll do a separate one today on bonds, fixed income, more so than trade ideas, which there actually is. We could look at it as trade ideas as well, but much more so the impact and things to watch for in the bond market. Various bonds, not just treasuries, that might give us clues to where the stock market's going. And then again, there are also trade ideas, trading opportunities there. And then I'll do updates on gold and silver, and I want to talk on Bitcoin as well. I intentionally haven't been covering it much lately because for various reasons, but I'll get to it. I know people are curious about it. It's been in the headlines lately, and we'll get to that as well. All right, so let's keep this one relatively brief. And nothing has changed on the weekly chart. We have a downtrend line there on QQQ. Biggest developments on the weekly chart was that a couple of weeks ago we broke, or last week really, we had a stick save the previous week. Last week we closed just below my T1 first target, not by a tremendous amount, but so far we're poised to close the week. If we close where we are now, another red candle, and again that helps keeps that bear flag scenario alive right now if we continue to move lower, and especially if we can build on today's losses, either build on or at least hold these into the close tomorrow. Ideally, you want to see, well, you'll still need to see a break of those lows. That's obvious before we get to T2. But like I like to say, the redder the better. It's just going to help for that bear flag scenario. And if that doesn't play out, the whole bear flag thing, it does not eliminate. What starts to eliminate the odds of my next targets being hit are, as I've said, a move back above that resistance level there, a move back above the 40-week moving averages, and especially a move back above 379. So if there was a line in the sand, that's probably it. But and I say probably because charts going to change. Some markets put in a double top. That's one top really, even though we traded there for a few months. Double top looks like that. Sometimes you even have triple top patterns. So again, the possibilities are infinite. I'm just telling you probabilities. And that's where I'm looking at now. But as of now, everything looks good. This short trade, is a trend swing short. We've been able to micromanage if you're an active trader, highlighting all the objective add-ons entries. And most recently, yesterday's, I'm jumping all the way from a weekly down to a 5-minute chart. There's that level we closed at yesterday, the 335.06, which I had highlighted in the video the day before. And that's where we ran to. We had the slightest brief overshoot. We closed at 335.08 yesterday, which was not only right on that resistance level that I had laid out, but also the 50% Fibonacci retracement, and then boom, a rejection off there. And I like them when they come in the form of a gap down during downtrends, because what it does, it tends to trap. If you're you're trying to trade the market long side, you're bullish, and you say, okay, I'll have a little trend line here and I'll have my stop right below the trend line. You get gap down, it catches you, it traps you, and then you're waiting for that bounce back that never comes. And it also, gaps like this in a bear market or bear trend deny. Maybe there's some more conservative, flexible investors like myself that, not the conservative part, but the flexible part, where you're just as comfortable shorting, but you said, yeah, you know what? Wow, that was remember, yesterday was on paper, You know, and to the untrained eye that hasn't traded bear markets, super impressive. It was a 4% rally, a one-day rally, a 4% QQQ, and I know there's people out there thinking, how can that not be anything but outright bullish? Especially because we had a day the other day we went up on the Qs, we went up 4.16, bullish, bullish, bullish. We're running up. Well, look, right now, yesterday it might have seemed that, but we rallied right into resistance. Remember, bear market rallies are that's the signature of a bear market rally. Above average gains, and then boom, you lose it the next day. Now look, here's what we need to do, and that's why I walked you down to 5-minute chart. We have a little bit of an uptrend possibly going here. I'm going to show you the futures in a second, but as I mentioned, we do have, as of now, still all the makings of an early, very, very near-term uptrend. That's a series of higher lows and 2, 3, 4 higher highs. So what I want to see is a takeout of this previous reaction low right there. Then I want to see this one get taken out. If that happens, I get check marks for the bearish case. What does that mean? It means many things to different people. It means you can maybe add to, initiate shorts. Again, everyone's trading on their own schedule, their own entry prices and all that, but that's it. That's what it'll be. Oh, not there. Nothing's happened yet. We had a gap down, so if I want to play the call by call, you know, do the minute by minute, call by call play thing here. Yeah, bears, a little check mark for them today on a gap down. Here's a big old gap. If we can backfill that gap, that's yesterday's gap. See, this is today's gap right here. Traders love these gaps. That's today's gap down. They tried to enter it right there today, got smacked down. There was also resistance, which I'm going to show you in a second on the futures. But then here's yesterday's gap. So it goes from there's a close right there. And so we've now entered yesterday's gap. Well, actually, we entered it there. We gapped down into it. Look at that, right on it, actually, 330.86. And we tried to get out of it, and we're in it. So let's see if we can get a nice backfill. If we backfill it, yeah, the buyers will probably step in there on the initial backfill, so you want to give them a quick bounce. But if we do that, think of it this way: we've wiped out then all that big 4% quote unquote bearish rally, and that's going to be a knife through the heart of the bulls. So I think we'll. So yeah, in other words, it's probably not one that I care to game. Let's look at the NASDAQ 100 futures for you. 60-minute chart, nothing's changed. Still got that big old downtrend line right there. Only things I've added, we had a little near-term downtrend that was popped, and that led to that rally right into that 13,381.50 resistance level there, which I had previously laid out. That's all these reaction lows there. That one, quite a few there, and then boom, rejection. So now we have this potential, again, potential uptrend line. Why did I say the word potential? Because it's only two distinct reactions. I know there's two candles touching there, but that's in close proximity. So 1, 2. I always say, this is just me, it takes at least 3 distinct reactions on a trend line to help validate it, because any 2 points can be connected at random. Also keep in mind, if you take it out, you're taking out those lows, and you're taking out after that low. And then I keep talking about it. We haven't seen what I consider true waterfall selling yet, and that's when the sell buttons start getting hit. The algos start firing in. They flip from buy to sell mode. Forced liquidations. It's a beautiful thing if you're short, and it's a horrible thing if you're long. So again, we're not far off those lows. It's funny because I turned the TV on today just to check on CNBC to hear about the inflation numbers were out today. And I want to hear about that, employment numbers, and so before I turned it off, they looped over and went in, and they mentioned, actually they didn't pull the analysts, but they said that JP Morgan still maintains I'm sorry for the chuckle. They still maintain the risk reward is to the upside in the stock market, meaning you have a higher potential for gains than you do downside risk at this point in time. So anyway, well, obviously we differ, but all right, that's the levels to watch. Those are the levels to watch. Oh, and I told you I'd show you the 5-minute. Keep in mind, guys, these are the March contracts on NQ. I am going to roll today over to the at some point to the next month out, and because it's time to roll. These are going to expire soon. You have on the 5-minute chart, you've been building some divergences here, right here. And they're still intact as of now. They're about to be, if we go much lower, they're going to be taken out on the PPO there. You'll still have it on the RSI. But what I see here, this uptrend line right here, I was watching this morning. We broke it, which is a sell signal right there. It's a bearish because you had plenty of reactions early on there. And then you back tested once, rejected, back tested again, rejected. Then you went on to take out this support. Again, I believe I shared all these levels recently on, this is a 5-minute chart NQ, 13,500. Boom, we just took out. And we also have a downtrend line here that may come into play if we rally. So these are the levels. Screenshot this. Maybe I'll include it under the video post. But again, we're going to roll soon, and I have to then do new levels on all the on the next chart here. Okay, and that loud ringing sound you just heard was a price alert that just fired off on US Bank Corp, USB. Let's go to that chart. It actually segues into something I wanted to talk about. Let me just check it because it's just happened. All right, ooh, look at that. Remember, I covered the banks. The banks are sitting, a lot of them on a edge of a technical cliff. Look at that beautiful sideways trading range. This reminds me so much. I've covered it many times. The top in IWM, we had a year-long well-defined trading range. We had one in Netflix. We had a lot, so many stocks had these, and most of those tech stocks have already broke them, and that's what happened. Here, I'll show you, because I know there's always new folks to the site. Netflix was right here. There was our range. We had a false breakout in it, like IWM. There was a beautiful sideways trading range. Shows well here also on the weekly chart right there. And then even better on IWM, the small cap index. So there was a false failed breakout. Nothing is more bearish than a failed long side breakout. Once the breakout failed, do you think it's mere coincidence you had a waterfall selling? People say that, and you know, earnings didn't happen right away. I can't remember exactly where they were, but there's just so much in this chart technically that said boom. That was it for Netflix, night night. Once that level was taken out, there was a alternative trend line there. But you know, back, I digress. I always do that. IWM weekly chart. There it is. There, see that same kind of trading range right there. Boom, 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 boom. Failed breakout, and that's what it looks like on the daily chart. So back to USB, and USB is just one of many, but it's one of the bigger banks, and see, my price alert, so we're right on the line. We haven't clearly taken it out yet, but when we take it out, that's going to be powerful because these are like, you know, like I use the analogy, it's like a coiled spring building energy. And when you break to the downside or upside, look, there, look, bulls could say, hey, Randy, maybe we break to the downside, have whipsaw. Absolutely. Absolutely, that may happen. First of all, I'll take the breakdown on face value. The reason that I told you back when they happened and before that I thought this one would fail is because breakouts that occur with negative divergence have a much higher rate of failing than breakouts that don't. So we were overbought and with negative divergence. That's why the IWM breakout failed. On USB, US Bank Corp, we just recently put in a big divergent high. So this the charts tell me, and not only that, we also broke down the primary uptrend line here and back tested it. So the charts tell me the odds favor breakdown here, and I'll take that breakdown on face value. If we had bullish divergences, which we don't anymore on the PPO, I might hold off and say, and here's the thing, maybe I'm wrong. Maybe we break down and we work back. This is trading. And if that happens, there's your stop. If you break down and you shorted USB and you regain it, especially on a solid close, second day close, you're back in the range, and then you know you can say, hey, guess what? That was a bear trap or a false breakdown. And you cover your short. You could even go long for a swing back to the top of the range. And so anyways, that's how you trade that. So it's not that you have to get married to any one scenario. I'll tell you what I think is going to happen, and this one's going to go, I believe. And then yesterday, XLF, again, this is where you had, so here was the close from the previous day, huge rally in the financials. At one point, they were up 4.5%. And so I have little doubt that probably paraded some people out on TV and all that, telling you why you should buy the banks and how bullish that is, blah blah blah. And I trade just almost agnostically. I look at the charts, And I'll tell you when a big move is technically significant, such as a breakout. If you have a breakout of a, let's say, a bullish falling wedge pattern, and it's 4.5% in XLF and the volume's high, great. That's very bullish. But when you have a bear market rally of 4.5% and it's back into resistance, that's a gift. That to me is like Christmas came early, because now you get a recycle back in. If you miss the initial breakout that I pointed out what happened when my yellow line was taken out, and that drop there, you just had a second chance and maybe the last chance, just like on IWM. IWM broke down of that multi-week trading range, had a big drop, and I harped on it big time as a sell signal then. And if you missed it, then I pointed out there that back test, and so far so good. And so it's the same thing with the financials. This is trading, and guess what? I may be proven wrong if we do this, or I may have been proven wrong today if we would have gapped up, but it's easy. These are the entries that I love. They're objective, and you can keep tight stops. You know, like I said, the risk reward, if your stop was just above that trend line, or I said maybe as high as that gap, and you're targeting a drop down here, and I'll probably add additional targets if we get close to that third target, depending on how things look. So if you shorted yesterday, you're talking a 15, almost 15% drop to T3. Take that, and I just want to talk on this because I'm going to keep this video limited to the equity markets. FAZ, which is a 3-time leverage ETF. One member mentioned yesterday that he took FAZ when I posted that objective entry on XLF yesterday, or FAZ I mentioned. And so I want to talk on this real quick, and that is the use of these leveraged ETFs. And I do that because I've seen a spike, a big time spike in the articles online about how these are bad and you should stay away from them. They should be banned, blah, 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 blah. Okay, for the most part, yes. If you don't know what you're doing, and I would say for 99% of traders, my trading style, for lack of a better word, I don't want to sound arrogant, but if I'm right, I'm often very precisely right. And if I'm right on how this is going to play out, it's going to be a pretty quick move. That's when not only are these not bad, but they're good, they're better, because I expect FAZ will probably do better than 3 times what XLF drops. And I just wanted to loop that in because I made that reply under the frequently asked or the comment section for the subscriber that said he took XL or FAZ yesterday. You can visit this on your own. You can go here, resources, click on the resources tab. Here, I'll show you. You click resources and then FAQ, frequently asked questions, and then come in here, sort them by ETF related questions, and click on this one. Is there a disadvantage to holding a leveraged ETF or ETP? That just means exchange traded product, like an ETN, for an extended period of time. I encourage you to read it. I'm not going to read the whole thing. The math is there. This is why if and when I'm right, I'll tell you exactly when you don't want to hold them and when you do want to hold them. It's all in here. And the bottom line is that the more up days that you're in a leverage ETF, whether it's bullish or bearish, doesn't matter. If you're in the right direction, the right trend, it's going your way. The more up days and the larger the magnitude or those up or down days, the worse the decay will be. Or this is actually when you're using short ones on a bearish one. Okay, so yeah, exactly. This is for FAZ. Essentially, the more up days that the index or the sector has, so in this case the financials, and the bigger the magnitude of those days, the worse the decay will be over time. And so, and again, if I've done this many times over the year, I've measured these moves out, and you can do it yourself. Just grab, any charting program will show you how much something goes up or down. So when COVID hit, I'll just do this one for you. It never, there's always spares repeating. So you bought, let's say when right before COVID hit, you saw it coming. I'd give you sell signals in the market. So you took FAZ there. I'm just going to measure and compare this to XLF. The move in that one was 225%. So, okay, so by that logic, you take a third of that, and you would think that's what XLF goes up, or went down. Okay, so 225%, so a third of that, 75%. So XLF, you would think dropped 75%, right? So let's go here. Let's say, and turn off all the lines, you shorted XLF right from the highs when COVID hit. No, it only dropped 44%. All right, so 44% drop. 44 times 3 would be 132. So one would think if there was no decay and 3-time leverage ETFs tracked perfectly that you would get a 132% return. No, you got 175. Why? That's it. That is what I call mostly unidirectional drop. This is when you get the decay, the back, forth, red candles, green candles. Okay, and I know I say this often if you follow me, um, so I just want to say, it never amazes me. I've never seen anyone talk to that, and give a positive spin on these things. Now, I will say, again, most people aren't as proficient as market timing. And, I always say this is one thing to call, where things are going to go. And I'll give you a great example of it. And this is, against me. I don't know if I recommended FAZ back then, but I put a sell signal and called for what I believe to be a major top in the financials back here when we broke this trend line, this wedge. That's when I laid out these targets initially. T1 got hit right away. And I'd have to measure it out, but that's not when you want to be in FAS. Now, I don't recall if I mentioned FAS because back then I wasn't as bearish on the market at all, not nearly as bearish, or the additional sectors. So what happened is financials, for all intents and purposes, peaked. Now, technically the top was there, but I already told you this, the top was only from where we had peaked right before that sell signal. Although the financials kept going up, they only went up 8%. And it's pretty much a slow roll. And now they're just starting to break down. So at this point in time, I do think and there's a big if, that's why this red line's here. When they take that red line, that's going to be even a more powerful sell signal. But all goes back to this, guys. The financials are only going to go so low because they're a major component of the S&P 500. They're only going to go down so far and so fast if the S&P 500 breaks down. So that's it. It comes back to everything I've been saying. We're going to take out these recent lows. I want to see these divergences get burned through. They're still there. I'd be a fool to ignore them or not point them out to you. So anything is possible. If we start, the divergences start playing out, we move up today, we hold the lows. Even if we take another low, we have an additional low and keep those divergences, there's a potential to get a bullish falling wedge. Trust me, guys, I love going long. I don't mean to be Mr. Doom and Gloom here. Right now, I'm pressing the shorts. I'm letting you know my thoughts. I'm telling you that, counter trend bounces are still, in my opinion, objective levels or points to add on. Sell the rips, cover the dips, sell the rips instead of buy the dips right now. And when that changes, I will let you know because I will be going long NQ and RTY and mid caps and everything else. Yeah, that's mostly it. Most of the charts I went over in the beginning of this video. There's ES for you ES traders, and also for you NQ or RTY traders that want to keep a pulse on the overall market, because I've often said this reason, even if I'm not in ES trading that, or I'm going to watch it if I'm in NQ or something else, because has a lot of the same stocks. They're large caps. They're all large caps in NQ and ES. And sometimes NQ might break down and then ES at the same point hits support and holds and bounces, and then the NQ breakdown proves to be a whipsaw. So all the better when I see both ES or the S&P 500, whether you're using SPY or QQQ or the futures, when I see them both break support. So I like what I'm seeing today so far. I see we had a little wedge. We had two little breakouts that both failed. They didn't get going. We had a rejection. So these are the key levels right now. And this is, again, guys, I'm down to a little 5-minute chart here. 1 week of trading history, kind of micro stuff. So this is a trend line that you can use to either short or put a stop. And you can also see horizontal. There's a horizontal resistance zone just overhead. So if SPY can come up here and pop this line and pop the horizontal resistance just above, I'm going to take this and drag that just over to today's high now and say that's a more significant level. And now there's still the potential here. It's by hanging on by the skin of its teeth to put in a divergent low on this little 5-minute chart. But sometimes these divergences, especially during bearish trends, get burned through. So these are the things I'm watching, and as an active trader, if you're, not a very active trader, nimble, don't try to be. Now, if you're not experienced, this is not the time to, cut your teeth unless you're paper trading or using very light positions. I point this stuff out because then you take out these levels, start a rally. Like I said, this is just a 5-minute chart, but very near-term stuff. If this trend remains intact, meaning or it gets confirmed by moving up here, we take out that line, then we take out this previous high. Well, hey, that's going to tell me we're probably going to then hit that those uptrend lines on the 60-minute charts that I talked about, and might even take a flip to a long in my active trading account just to game that. We'll see. It depends. It depends if it's enough, and then boom, if we take that out, well, that's going to have some bullish implications. But unless that happens, we're in a downtrend, guys. So that's it. The levels to watch. Let me get the video out to you guys, and I will follow up with analysis of bonds as both trade ideas, more so for the both clues for the market and really longer term macro, bigger picture stuff. There's a lot I want to get out there and talk about, and interest rates and the different bonds, municipals, corporates, junk bonds, investment grade, treasuries, and then I'll do an update on Bitcoin. I'll squeeze that in as well. And then not much for me to add on gold and silver. I already give you those levels, and they're bouncing off those levels pretty good. So, but again, I'll do an update later today. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.